All right. Good morning, everybody. Hello, hello, hello. How's everyone doing today? Please let me know if you can hear me. Hope you all had a wonderful weekend. I know I did. Good morning to you, Miles. Markets are about to open. Actually, they just did. As usual, we're focusing on the upper right-hand corner chart, the Dow Mini, and there's a long trade. We'll pick it up at 726, 34,726. Maybe we'll miss it if it doesn't go up. I'm sorry. Yeah, it's 34,726. And if it hits the stop, we'll just cancel, and we will cancel it. So there's a trade we have just canceled. Good morning, Steve. Hello, John. Crude oil did its job. We'll review it in a little while. Took a few trades, but it did its job. And you can see pound Aussie on the left-hand corner also getting long, going through all four targets. Still trailing, but that's one and done. Mondays tend to work out pretty nicely, pretty quickly for us mostly. Good morning to you, Johnny Seattle. Glad the sound is robust. Appreciate that. Crude oil, just crazy. Down $8 today. Again, we haven't seen those kind of swings and ranges for, it could take a whole year to move $8, it seems, or months. Now it's like almost every day. That's crazy. If you think about it, that's $8,000 a contract, an $8 move. $8,000 a contract. It's just crazy. I'm showing the micro crude on the lower right-hand corner. So far, nothing on the YM, although I feel like that might have been a setup to go short off the 200. I wonder if I got that set up right. Let me think. 726. Maybe I don't have that setup turned on. I think that's probably the case. Yeah, trading off of the 200 moving average could be a pretty powerful setup at times. And I'm not sure that's a setup we've used in the past, but I'll show it to you now. It's where the exhaustion dots are within the proximity of the 200 moving average. And there are times when that can be a really powerful setup. And as you can see, there it is. It's when your exhaustion dots are within 4 ticks from the 200 moving average. And when it's throwing up support or resistance with the 50 pushing down, and you can see it try to get higher and bounced off of it, that's the time to use that setup, obviously. But geniuses after the fact. I'm going to turn it off just because it's not a setup that's been on for this trade plan, but it could be. Wins a lot. We'll still wait for that first setup of the morning there on the YM. Pound Aussie still going. And I do want to hop over to soybeans because this is also happening right at the moment. So no setups on soybeans yet. There was some earlier. Keep an eye on that one. All right, so while we're waiting, got to go back a ways to find the crude oil So there was this short here off of the 20 SMA, which that's going to be a losing trade, but it flips over to long, and then that one's going to win 17 ticks. My guess is it lost roughly around that amount, also give or take. So call those two trades a wash, maybe slightly negative, but then it got short here. Yeah, you have plenty of time to take that one, and that one, nice winner through all three targets. And so that would have been the power of quitting trade, the third trade of the 9 a.m. session. So there was a really nice short. I mean, obviously there were a few other up and down setups in here, but power of quitting already achieved. So not going to try to catch them all, but that trade plan got it done for us. Soybeans, while I was talking you through, got long and hit its targets. Plenty of time to catch that trade as well, and you could see soybeans one and done, like, again. And John got that on the micro. Well done. So soybeans one and done. I mean, what an amazing trade plan this is. As you can see, it just keeps winning, and it wins fast. A few minutes. That's it. If that's all you did was nothing else but that, you'd be pretty happy. Still waiting for a Dowie mini trade. There would have been blue setups, right, to go short off that 20 SMA, but those exhaustion dots are just not close enough. They're barely missing. 6, 7, yeah, barely missing. That one missed by like two or three ticks, 2 or 3 points. It's not quite close enough to give you that blue short setup. And then Pound Aussie just finished, so really great trade there. One and done. Unleaded gas, just to follow up. Great short, but unfortunately too soon. But there's the winner. First trade of the morning, long on the green, and getting to, did it get to target one? All the way to 84. Got to 83. Missed by 1 tick, and then got short here. And there's your power of quitting, unless you count the 1 tick to target one. You can count that as power of quitting, because that's always been one of our rules, that if you just barely miss a target by a hair, you trade for profit, make it profitable, and you could have been one and done on that first trade. But if you did take a second trade, that one too, you could see. Look at that perfect target two. So target two was at 36, and it got as low as 37. So missed target two by 1 tick, missed target one by 1 tick, and unleaded gas getting it done also. Obviously, you got spread considerations, and unleaded gas is like, takes time to learn how to trade that market. Just quickly looking at the volume, though, you're up at 11,000. It's kind of thin. I mean, that's why you got the spread that you have. You have to be willing to work around that and try to finesse your orders with stop limit orders, and maybe you don't catch them all the time. Donald, that's a 5, just to answer your question. Soybeans, it's a 5. Yeah, John just answered you. 5 range. Our good friend Bill Miller from years ago, haven't seen or heard from him in a while. I know he's out there somewhere. Soybeans, he really, that was his chosen trade plan from years ago. The exact same plan that we see winning every single day here. All right, so here we have a short that's off of the blue line. And these are the dangerous trades because look how far off of the 50. I mean, it's just been trending down, 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 down. And this is when this is the low odds trade. Would have been nice to catch them all the way down, but I'd be skeptical of this one. It doesn't mean it won't win. And this is the blue trade. It's red because red shows up better. I just thought let's keep it red. See how it looks. But the point is that that's for the first trade of the morning is probably your riskiest trade. I mean, we could get nothing but down, down, down today, in which case any short is going to work better than longs, and this could be a winner. And it is the first trade of the morning, but it's like the one I'd kind of hold my nose and not be too thrilled about taking. I'd probably be inclined to let it go personally because I just know the strength and weaknesses of this particular setup. And it's, could be the Johnny come lately setup or the Johnny came too late setup or whatever you want to call it. Not really making any comments toward the Johns and Johnnies in the room. Yeah, session lows, exactly. But that doesn't mean it won't keep going lower. It's just the trade could win too. I just find that the odds are not in our favor. And look how oversold it is. So you also run the risk of stop reverse, which could get you into more than one loser in a row. Do I have a trade plan for the ES using Unirenko? That's a really good question. All right, so first of all, we got a long now. Like I said, we could get a stop and reverse, and there it is. 608, the long trade. Normally with a setup like this, I'd maybe want to see it come down and test the lows and then go back up and get in sync. But since it's been trending down so far, and you got that 50 moving average up there, you could still wait for it to come up again. But that's the first trade, in my opinion, of the morning, 34,608. Targeting 634, 648, 662, 676. And the stop is at 574. So here's what I would do, Don. I don't have a specific plan per se, and it depends on if you're talking about Catapult or one of the other charts or strategies, Counterpunch or Spotlight, but I would start with the same thing we were looking at with the NQ and then go down. Like, I don't think you're going to get enough action like you would with the NQ. Yeah, so with Catapult, I would keep it to try the same idea where you offset it by a third. So with the NQ, for example, you have a 6-point bar and a 2-point offset. That may not be appropriate for ES, but it's a starting point for you to look at, right? And John, yeah, the power of quitting off the Magenta trade, it's just not a setup that I typically have turned on. I showed you that a little while ago, and you're right. That was the trade this morning to take, and it was an obvious one with the 50 pushing down hard on the 200 and it coming up. Support becomes resistance, right? So once it breaks through the 200, you could see that you could almost see it transitioning from support to resistance before your very eyes. And then it comes up again here. And that's the trade to take, obviously. But since it's not a setup that I've kind of had on, anyway, I agree that was the power of quitting trade, but there you go. Anyway, Don, that's my, I would start using good old-fashioned sniff test techniques and just eyeball the charts, starting with a 6-point and a 2-point offset. And that may be too large, but you could always use the micro ES. And if you don't get enough movement and enough trades, then go down and go smaller. But that would be the starting point. And I would also just be careful, if you're trading the full contract, that $12.50 a tick's pretty costly. And you're going to have a lot of costs because of their bid ask, having to trade through price levels to get filled. So it does have additional challenges that you probably have to learn on the job with real money, because it's never going to really, you won't be able to simulate it in the sim account and get anything useful when it comes to actually filling trades. You understand what I mean? Right, and John putting the numbers in for Ninja. You could try that on ES. My hunch is it's too big. I mean, we could open up a chart and look at it if you'd like. OSOB on Spotlight and HT Chop on Counterpunch are completely different. They don't have anything in common with each other. The only thing they have in common with each other is nothing. How's that for an answer? I mean, literally, they have zero. They both print on the chart. That's what they have in common. So the high trend chop indicator is showing you the fast trend on a chart 5 times slower. And then it also shows you when the market has entered into a Bollinger Band squeeze that we call the chop zone. And then you use the 50 moving average to filter out some setups. So that's what the high trend chop indicator does. And it's meant to corroborate the actual counterpunch trade. So if you understand what that is, then my explanation makes sense. If you don't know what that is, then you're probably scratching your head. But the OSOB indicator is about if a market is overbought or oversold. And it has nothing to do with trend analysis at all. Well, the green line has to do with trend strength, but nothing about time frames 5 times higher, or chop zones, or anything. They literally don't have a single thing in common with each other. And they're both part of 2 completely separate strategies. So one thing does something for a particular strategy, and the other thing does something for another particular strategy. Remember, a strategy, just think about that, what that means. To have a good strategy, you're really looking for stacking up price action confirmation pieces of information. And when you have enough of them stacked in your favor, then your odds they go up. And you can start to identify patterns where the outcome is predictable. And that's the basic concept of a trading strategy, right? You're at the right edge of the chart. You have to take a trade. How do you know what to do? Well, we use these strategies and indicators to identify patterns where the likely outcome is predictable. Statistically, the odds are if this happens, then that will happen. And it won't be perfect, and it won't happen all the time. It's just if it happens enough so that you win more than you lose. That's what trading is. And so these indicators help stack odds on our side as they corroborate certain price patterns. So it really helps to understand what these components are meant to do and why. Because these strategies exist on the chart, even if you don't see them printing on the chart. They exist. I didn't invent them. I discovered them. There's a big difference. These already existed. Just like some weird element in nature that's never been discovered. Some scientist discovers it. They didn't invent it, right? It already existed. They just discovered it. It's kind of the way I think about things when I'm trying to create something, whether it's a strategy or something else. It's like, I didn't invent this stuff. Just figured it out. That's all. Cracked the code. And these indicators are just meant to help. All right, so it's looking like we're one and done on the YM. I mean, I think we just hit money management. We're not quite at target one yet, but a good chance we will be shortly, and there it is. All right, so target one in the bag, 26 points, the Dowie Mini. Remember I said I'm avoiding that one, that short, and then told you why, and that's exactly what happened. It's not because I'm smarter than the next guy. Of just, time and experience. How many times have we seen it? That's why I show these moving averages. When you get extended way beyond the 50, and the 50 is equally extended from the 200, you have to realize the 50 is the 50 for a reason. I mean, there's a 50 moving average. There's a reason. The price tends to want to pull back to it. At some point, you get that reversion, and the odds of that happening are a lot greater than extending lower and lower, widening that spread away from the 50 even further. Like, that's not as common, right? Dawn, how have those worked for you? I'm not a big ES fan, as you know, after all these years. We can explore some ES charts if you'd like. The problem, again, with the ES is if you can't know you're filled on a price level, and a lot of these strategies are so accurate, you hit the target perfectly, and then it backs off. It doesn't trade through the target, but it trades just exactly to the target, and that's your big problem with the ES, right? The big problem with the ES as the YM hits target 2 is when you're testing it, you don't know if you're filled. And so how do you get accurate test results? And what happens when you hit a target, the strategy has done its job, and then instead of trading through, it backs off a tick or 3, right? So it hits a target, it backs off a tick, backs off another tick, backs off another tick, and you're still in the trade because you couldn't get filled. And so while the strategy hit target 1, for example, you should have come off with your profit, but you never got filled, so you're still in the market. And now it's 3 ticks behind, backed off at $12.50 a tick per contract. Now what do? Do you mark it out and then pay another tick or 2 of slippage also and give away a big percentage of your profit? And how many trades does that happen on over and over again, projecting into the future? You see, those are the issues that bother me about the ES. And then how do you test that and show? The only way is in real life. You have to trade it for real with real money going forward, and that's costly. You may find a solution and an operation or some sort of maneuver that you do when you hit a target and don't get filled. What do? Wait 3 seconds and mark it out, pay the costs? I don't know. But those are things you have to work out over time, and that's where the costs come. Those are hidden costs because you have to do that in live markets. The sim account won't help you. Sim is fake. It's simulating what could happen. Is not whether it does or not, who knows in real life. So therein lies the issue with the ES. And so then the next question is it worth it when there's so many other markets that you don't have to worry about that? Anyway, I'm just asking that rhetorically, Don. I'm not trying to knock you down or discourage you, but I do want you to go in with your eyes wide open and understand what's involved if you're day trading the ES. Just initial thoughts. It's the nature of that market is unique, and it's rigged. It's rigged to make it harder. $12.50 a tick. Got to trade through your price to be guaranteed of a fill. And so those two things alone make me look to other places. The NQ is too fast right now these days, and that's a problem too. Unless you find the right time frame or strategy where you mitigate the speed. Maybe Catapult's the wrong strategy. For the current market conditions. I mean, I never came out with an NQ module that I sold as a boot camp because I never had the confidence that Catapult was the best strategy for the NQ. We could see how much it wins. I mean, we could obviously see it. But there's the practical side of things when it comes to actually trading it. I mean, a 5-minute chart on the ES or on the YM with the original Catapult plan is still a really nice plan. It gives you plenty of time to think, to react, and you can get really good at it and then make small, nuanced rule changes that fit your sensibilities with time and experience. And then you could try the same thing on the NQ. But for a trade room of 5-minute charts, just not, I don't want to do it. But, I mean, you could use time-based charts. I mean, I wouldn't rule them out, in other words. Or if you do rule them out because you've tried them and tested them and you just have decided they're not the best chart. But they could be. A time-based chart could still be very good, and maybe that's part of how you mitigate the speed of a market. Or maybe even the whole thing I talked about with having to trade through prices on the ES. Maybe you just need larger setups, and the time-based chart might give you the patterns that work better. I don't know. Yeah, so look at John's already pulled up the 5-minute, and it already hit target 1, and there you go, one and done already. But, I mean, if the Renko is too fast, don't be seduced by any particular chart because it looks cool or because, you know, after the fact you see on the chart how great the trades were, because you still have to be able to take those trades. And the Unirenko has its own challenges that make it hard sometimes. A time-based chart has different challenges. But one thing good about a time-based chart is you can predict when the bar will close and the next bar will open, because it will be right on the 5-minute mark every single time. And there's something to be said about that. Something good. So, I mean, food for thought, and I wouldn't rule it out. By the way, you can see the YM before I close. Got to target 2, didn't get to target 3. But that's 40 points, $200 a contract, and you don't really have to worry about getting filled on the YM. I don't know if I have any ES charts handy. We could always make one. Let's look at the NQ really quick. Johnny, I see your question about curve fitting. I'll talk about that next. So remember, we wait the 4 minutes. At least that's what the initial idea was. There's like 3 minutes and 52 seconds, not quite 4 minutes, unfortunately. and then you got this. So, I mean, was this trade tradable? I don't know. It could have been. It's hard to say when you're back testing and you want to see if that short trade was tradable or not, and should you count that. The only way you're going to know is if, first of all, you were there watching it in live time. And if not, if you're back testing and you see this, could you have taken that trade? What I like to do is pull up like a 15-second chart, and you could do that. You pull up a 15-second chart, but first you mark the entry and you mark the stop. Where is the stop? Over the arrow, right there, I guess. Let's get that arrow out of the way. Yeah. I'll show you what I mean. So, was this tradable? Copy, paste. I'll show you something. This is what I do if I'm back testing and I want to know, even if I'm fast testing, do I want to count this in my result? Is that a legitimate losing trade, or is it a trade that it stabbed through the entry so fast it would have been impossible to execute on, and then it's a losing trade that wasn't a trade at all because you couldn't execute on it, right? So that's important information when you're testing, because there are going to be plenty of times, even with winners too, you have to do it with both. If you can't execute on it, it shouldn't count, right? Win or lose. It's just a non-trade. So here's the 15-second chart. Now, that was at 8:33, and what was the time on it? Let's just, well, first of all, I have to make it a 15-second chart. Let's do that first. You can see it's right there at 8:35. Let's check the timestamp on it. All right, so the timestamp's at 8:35 on the nail. So now we know the time. What we don't know is if we had enough time to execute. I'm only going to we'll look 500 bars back on this one. Why is it not clear? Oh, I know why. Okay, so we got to go seconds. 15 seconds. So we could literally pull up a 15-second bar. And you could even look at a 10-second bar. Let's do that instead. 10-second bar. This is how you could verify if a trade legitimately was tradable or not when you're testing. So you pull up the 10-second chart. We'll let it load some data. Probably would have been better off looking back 500 bars and not a whole day, but let's just, now we have to wait. All right, let's go to 8:35. It's not that far. Look at that, 10-second bar. So here we go. Here's the lines, and 8:35 is right there. So 8:35. So 8:35 and 10 seconds. Inside of that 10 seconds, this smashed through the entry and then went up. So the first 10 seconds. Now the question is, do you have enough time to execute on that? So you might now have to look at a 5-second chart, because what I've noticed is when you see the tail just barely touching, that it usually happens at a blink of an eye. There was like one print and there's no way to execute on it. I mean, I'd be confident enough to say that trade was not tradable. But you could always look further. You could look at a 5-second chart. And, I mean, look, if you're really good, you should be able to place a trade within 10 seconds. But that would mean 10 seconds, the bar closed at the entry. Because TradeStation prints the time on the close, and the close was up here, right? The close was here in 10 seconds. So this probably happened faster. Obviously, it did happen faster. So my hunch is it wasn't tradable. So, I mean, I'm not going to go into a 5-second chart and we could verify. I just wanted to show you the technique on how you can verify. And that's pretty important to be able to do that. Because if you're testing and you want to make sure that the trade plan will win for you, you need accurate trade information. And so there's a way to verify. So we're going to say it was untradeable. This one here, right? Because here it shows it closed up 15 seconds. And we saw 10 seconds. It was right up in there. And, you know, it could have been 1 second or 3 seconds or 7 or 8 seconds where it just stabbed through that entry and most likely was way too fast. So now what about the next trade? Was that tradable? Well, I'm 2 seconds in, but then here we are in 45 seconds in or so, and it's still stabbed down through the entry. And again, you would have to do the exact same thing. You'd have to put your lines on the stop and the entry and the stop, copy it, look at a 10-second chart again, and see if this trade was tradable. My guess is that it was, because somewhere in here, maybe not though. I mean, that's just a guess. It might have not been tradable. But that's how you can verify. But you see how much extra work a Renko bar is? Even a range bar in general? It's a lot of extra work, isn't it? When you're trying to test and put a plan together. You've got to be dedicated to that kind of work if you're going to prove a plan will make you money. If you're not dedicated to that kind of work, don't bother using the chart, because you're going to learn the hard way in real time and lose money on the job training that's costly. Any questions about that? It's important. And so, Don, one of the reasons I'm showing you this is because you may encounter that with the ES. But there's an additional challenge, is that what happens when you hit the entry or the target or the stop right on the nail and you don't trade through it one tick? And now you have to decide, was that a winning trade or not? You don't know. How are you going to know if you weren't there? If it did not trade through the price, you have to assume you did not get filled. Then what do you do? Rhetorical question. Okay, so be careful. So Johnny asking, as I am experimenting with performance reports, how do I keep myself honest and know when I've crossed the line into wishful thinking? Usually if it's too good to be true, it's probably not true. So here's the thing about curve fitting. You could look at past data all you want. You could look at what happened over the last 3 months, and you could continually optimize your settings so that they become perfectly fit to what already occurred. And now you've got like every trade wins, or a huge result that, you know, it's winning 80+% and it never loses hardly ever. Now, maybe you're lucky. Maybe you just hit upon something. I mean, with the pound yen 4-hour chart from 8 years ago that was winning 85% for a 10-year back test, I was worried that was curve fit, but then we started watching it going forward, and it kept winning, and it still is to this day. It just hit new equity highs, and it's still winning 85%. I would say that wasn't curve fit. Maybe it was, but it was, I mean, it's curve fit going forward into the future too. The thing is, markets always change. So what worked perfectly in the past, the odds are it's not going to work perfectly going forward because the markets are going to change and all the inputs that you fit to what happened in the past no longer fit. Like the hand, it's like putting a rubber glove on a hand. So think of this, the past data that printed the patterns on the chart is the hand. The latex glove that you put over that fits snugly. That's your curve fit. So what happens when the middle finger grows really large, pointing right at you? Does it poke a hole through your glove? Probably. Depends on how resilient your glove is, I guess. With the pound yen 4 hour, it was stretchy enough to be able to continue to encapsulate and envelope the middle finger that's pointing at you, right? Most of the time, though, that middle finger is going to pop right through and break through. And while you're staring at that middle finger, you're watching your account go down, 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 wondering why you're not getting those great results going forward. Because you probably curve fit the back data, the market's changing, and the trade plan and strategy does not have the flexibility to adjust itself and continue to give you great results. You get the middle finger instead. So that's why I say your manual back testing with your eyeballs is a lot more important in the end than the optimized back testing. The optimized back testing will give you some general information that you could then work with using your brain with time and experience and living with the markets. That's why calling a live trade room for years and years and years put me in a unique position to create enduring winning trade plans. It didn't come from running optimization tests. It came from living with the markets and paying attention. Yeah, I guess I have an aptitude for patterns. I play drums. Does that have anything to do with it? Some would say it does. I don't know. But it's not easy to come up with a winning trade plan. And when you do, that's a treasure. That's something of extreme value because it's very difficult to come up with. And it's even more difficult for the winning trade plan to continue to win into the future. And then continue, and years pass and still winning. Think about that. If it were easy to come by something like that, everyone would do it and we wouldn't even have markets anymore. Markets wouldn't work. There'd be no risk anymore. We need risk to make money and, of course, lose money, but risk becomes a tool for us. But there are those plans that do endure, and we need to guard them and protect them. And that's why a lot of people are very secretive with them, because they're just extremely valuable. Right, so Miles bringing up a different point, and it's actually a really good point. So he says that until you put real money on the line, it's hard to know how you're going to behave, and that you can't backtest that. And you can't get it with sim trading. I would say it's true what you say, but you could use the back testing and the sim trading as a building block to help with that behavior. Because here's the thing, Miles, this is the whole point. These are why I put the steps in the Steps to Success guide the way I did. When you are back testing and when you are sim trading, first of all, let's start with the back testing first. You have to know what the purpose is for those things. The purpose is not to solve turning Miles from the guy trying to trade into Miles, the CEO of his trading business. It's a stepping stone that goes into that transition, but it is not the thing that by itself will cause that transition. And when I say transition, I'm talking about the transition of Miles, the guy trying to trade, transitioning into Miles, the CEO of his trading business, right? There's point A and point B, and then there are the steps to get there. And I'm talking about the emotional part, but it's a really great point that you bring up. So the way you solve the emotional part, you have to have those components as part of the solution. You use the back testing to help prove that if you only trade this plan according to these rules, you could see that it will make you money. That's what the back testing does. It gives you statistics so that you can gauge if this business endeavor will make you money as long as you can execute on it, and if it holds up going forward, right? So without that component, there's no way you're going to believe in what you're doing, and you will never solve the emotional part because you'll continue to get slaughtered by the market, right? So just think about this for a second. The back testing is just gravel that goes into your foundation to make your foundation stronger. It's part of the rebar, the steel rods that go into the foundation. Okay? The next step, of course, is now that you have a plan that you've back tested and statistically is going to make you money, you start believing in it more and more when you do the back testing manually. When you're typing the trades into the spreadsheet, you've got that third and fourth losing trade, and you're starting to feel the acid reflux because you're imagining yourself trading it and losing money, but you forge forward and you continue with your back test, and then you see all the winners come pouring in and the new equity highs being made. And you go through that process over and over again, and that helps push you closer to that transition of becoming Miles, the CEO of your trading business, because now you're living with the win-loss column. You're forcing yourself to proceed even though you've had to live with some losing trades, and even though it's all hypothetical still, it still affects you psychologically. Now with the sim trading, that's where you prove you can execute on your plan. And if you do it right, you get that 25 in a row without a single mistake. And now you're forward testing what you back tested, right? You're forward testing. And while you do that, you're reinforcing your belief because you should still see the statistics moving in your favor. It'll force you to live through losses. If you treat your sim account like it's real money, I mean, you have to treat the sim account with reverence. Don't just be flippant. It's a sim account, who cares? As soon as you do that, you're dead. Because practice how you play. You practice like that, you're going to play like that, you're going to lose your money. You treat that sim account with reverence as if it's your real account. And you strive for the 25 in a row without a single mistake, following the trade plan that you back tested and statistically proved will make you money. So then you get that 25 in a row without a single mistake because you want to turn it into riding a bike. You want to turn it into reflex, no thought process, only reaction without psychological attachment to the outcome. As long as your focus is running that trade plan, not making or losing money, forget that part. Running the trade plan, can you do it? If you can do it 25 times in a row without a mistake, you're going to be far better off than, I'm going to say, 99.9% of the traders out there, even though that's probably an exaggeration. But you understand the point? So you go through those steps, and now just think it through. How do you think the emotional part is going to be now? compared to if you didn't do those things. Doesn't mean it'll be perfect. It doesn't mean that you're ready, but you'll be a lot closer. And you'll be able to identify what the issues are that are preventing you from that full transition from Miles, the guy trying to trade, into Miles, the CEO of your trading business. You'll be closer to figuring out what the issue is that's preventing that. And I'll tell you what it is. I already know. Even if your name's not Miles, you're someone else. There's a blanket statement for everybody. I already know what the issue is. If you've gone through that and you still are having problems when you have real money on the line, it's because you're over trading, too much money, too much risk, you're uncomfortable with it. That's the indicator. You are the indicator, not the lines on the chart. You're trading too big and you don't know why you're trading. You don't have your reason in place. And that's reflected by the things you do, your actions, not what you say, not what you think. It's what you do. Because if you don't do the stuff that's going to make you money, it's because you're not trading for the right reasons. You're afraid to lose. Well, fear of loss is not the right reason to trade. You're trying to validate how smart you are. That's not the right reason. It's only a handful of things why people trade. If you're truly trading to make money and nothing else, which is the only reason to trade, that will be also reflected in the things you do. You have to be honest with yourself and watch what you do, because that tells you why you're trading. If you're really quiet enough and honest enough to think it through, you will find that what I'm telling you now is, that's the code you need to crack, basically. All right, so great question, Miles. John, should I put the parrot back in the cage? Because this is what the whole trade room and the whole backpack trader theme is all about. All these years, it hasn't changed. And you just hit it right on the nail, Miles. Trading's not easy, but it doesn't have to be hard. Let me see what John says. When it comes to snapshot trading, why are the times 4 and 8 p.m. good times to look for swing trades on the 4-hour daily charts instead of times like 8 a.m.? Then again, 4 and 8. Then Lazar says, usually it is a practical consideration when you are available to trade or something similar. Daily charts are effectively snapshots since all trade setups will occur at 5 p.m. Yeah, so John, let me just elaborate on that. So first of all, the pound yen 4-hour chart that only uses a 4 p.m. and 8 p.m. bar, and by the way, I'm glad you're paying attention to that. That came from back testing. That came from optimization. That put fear in my heart that it might have been curve fit. All right? Full disclosure, trying to think back on what I was thinking from 8 years ago. Right? So I tested those bars only because I had the tools to be able to do that, the automation tools. It was just a unique approach, and it made a huge difference in the results, like eye-popping difference. If I were to use all the bars on that 4-hour chart, the results were very good, but they weren't nearly as good. More trades, more losses, lower win rate, etc. As soon as I eliminated those bars and only focused on the 4 p.m. and 8 p.m. bar, now consider this also, I'm on the West Coast, so for me it's 3 hours earlier. Those are New York times. And I was also thinking about myself and what I could manage. I'm not going to be wanting to worry about trade setups that happen in the middle of the night, for example. So that was part of my motivation for seeking out that idea of just testing these bars only. And then I also had the 195-minute chart, which had me thinking, gee, that chart's unique. A 15-minute bar, a 195-minute bar, and a 180-minute bar, and then it's the next day. And so that got me thinking, Those are very unique bars. And I saw some, the setups that happened on certain bars were better than on others, et cetera, et cetera. It's just, it all comes from a lot of time and experience. So I tested the 4 p.m. and 8 p.m. bar, got these amazing results, and that's what stuck all this time. But none of that has to do anything with the question of snapshot trading. It's a totally different thing. Snapshot trading is a way to make sense of, let me back up. It's a way to take advantage of swing trade setups that could happen at any time, 24/7, anytime, but you can't be watching the charts 24/7, right? None of us can, none of us want to. So we use snapshot trading. It's not even my idea. This came from Mark Soberman of NetPicks. Such a great idea. Obviously, when, the lights, the epiphany moment happened, the light bulbs went off. Because a lot of times, and we see it in day trading too, the bar gives you multiple opportunities to get into the trade. You can get into the trade as soon as it's set up. You can get into the trade a certain amount of bars after, right? Well, if it's a daily chart and you got 5 or 6 or who knows how many bars after, each one is a full day. So why do I have to worry about being in front of the computer at the very moment the setup occurs, maybe in the middle of the night with a 4-hour chart or whatever? You don't. Snapshot trading says, get in sync. Look back and see the most current trade, and then you could still take it. Every now and then you'll miss a trade. That's fine. We let that happen. That's called surrender to what we cannot control. But here's the thing. You have to have rules. You have to know when to not get in sync, right? So my rules have always been if the stop has moved. So if it's already hit a target or a money management level and the stop's moved up to break even, it's too late. That trade's done. Wait for the next one. But if that hasn't happened, place the trade. If it pulls back and hits your entry, you're in. And if not, you cancel. And so snapshot trading lets you just spend a few minutes a day of your life, but you still get to benefit from the results of these great trades. There's a little bit of compromise, but the compromise is a trade also. The compromise being, it could move really fast and you miss the trade. Some of those will lose, though. You can't worry about being perfect, but you can take advantage of a superior plan without sacrificing your lifestyle. And that's the trade you're making. It's a worthy trade. So you use snapshot trading, you take advantage of these great trade plans without giving up your lifestyle. That's what snapshot trading is about. That's the whole point. John Curry, does that make sense? So snapshot trading becomes a very powerful tool. I talk about it in my books. The new Forex Quick Start Guide just came out a month ago, by the way. Maybe you guys know. My second book. Pretty thrilled about that. Never thought I'd even have a book. Yeah, the idea is super important because we want to be backpack traders. What does that mean? Does it mean schlepping a backpack all up and down everywhere? No. Backpack traders comes from my own story that was all about personal freedom. I had the freedom to go here and go there whenever I wanted because I could place a trade no matter where I'm at. and it'll work for me even when I'm not in front of the markets. The trading is working for you. Or if you're day trading, you get it done quick, obviously. But the point is that the whole idea of Backpacktrader is to give yourself freedom from trade, that because trading gives that to you. So you don't want to then make all this success with trading, have all this success, but then you're glued to your charts and you're really not free, right? It becomes a job. You don't want that either. So the symbol of Backpacktrader is leverage and using the market to give you that freedom, but that you still want freedom from the markets also. You don't want to be sitting in front of your charts all the time and worrying all the time. You don't want it weighing on your brain even when you're away from your charts. You don't want that either. So then you put the other components in place, right? Your risk management, money management, time management, and that's where snapshot trading fits in. That's why Spotlight FX Alerts is so, I really hit something on that because we're using the counterpunch trader, which we all know works, has worked for years. We see it every day. Same plan as soybeans, really. Not a big difference that we're using with the Forex swing trades. Takes a few minutes a day or less. And Kevin just told me we broke out over 31,000 pips. We were just pushing on 24,000 pips a few weeks ago. We're pushing on 31,000. Our third year anniversary is in June. That's more than 10,000 pips a year just by using snapshot trading, for example. A few minutes a day or less. That's Backpacktrader style. That's why Spotlight FX Alerts has just been so successful. It's the concepts that went into it. It's no good if it doesn't work for you. It's no good if you can't execute on it. Yeah, look at all those winners. But I got to sit there and stare at the chart 8 hours a day. Good luck. That's not going to work for anybody that I know. The old school, old guard traders that used to trade in the pit and that's all their whole life was all about that. I would venture to say that a few of them might have been happy, but most of them were just like living their life in that grind. But we get to trade from anywhere, at any time, and it's how we fit it into our lives that's important and what it does for us. And that's where snapshot trading is just priceless. So big thank you to Mark Soberman for that. And also John saying the obvious for day traders, why POQ, power of quitting. Power of quitting. Think about what that is. We throw that around all the time, but we don't really think about it. You're empowered to quit trading. That's pretty amazing. You're empowered to turn it off and walk away. You hit your trade plan goals. Trade plan goals that you went through back testing and practiced in a sim account. All that foundational stuff to create that in the first place. Power of quitting is part of that also. And all those things is how you build belief and transform from the guy trying to trade into the CEO of your trading business. And that's where you all want to be. That's the goal. And if you're struggling to get there, the easiest fix is to watch what you do and then figure out why you're doing that. And the reason will be because your reason for trading is not, you don't own it. You're not owning why you're trading. It's owning you. And I think my work is done here today. I don't know. I can't tell you anything else that's going to be more important than what we already just discussed just now. Anyone can learn techniques. Anyone can learn strategies. That's just painting by numbers. put the green in the number 3, put the red in the number 2, and the blue in the number 5, etc. You make a picture. That's all it is, learning a technique, learning a strategy, learning a trade plan. Miles' point about the psychological side, that's where you turn that into real art. But you use those tools to get you there. And one of those tools is knowing why you're trading in the first place. That's like the number one most important thing of all. And then watching yourself and what you do, because you are the number one indicator, more important than any dots on the chart, any lines on the chart. The things you do is what indicates where you're at and what you need to solve to be successful. If you wouldn't mind hitting the like button, I'd appreciate it. If you enjoyed this session, let me see if there's any more questions before I say goodbye. Hopefully it was worth your time being here. All right, Johnny, good. Glad you enjoyed it. Everyone have a wonderful day. Don't forget, John will be here tomorrow. I'll be here Wednesday, Thursday. It's looking like a normal schedule this week. Enjoy the rest of your day, everyone. I'll see you next time.